Hi, I'm Roger Montgomery from Montgomery Investment Management, and welcome to this week's Video Insight. Many of you will know the market has bounced quite convincingly. In fact, many believe that the low is now in. Led by the Nasdaq and the S&P 500, the ASX S&P 200 has also bounced rather convincingly. It wasn't that long ago that REA Group's shares were trading at $96. Most recently, they've traded above $131. So the bounce seems convincing, and it feels as though peak inflation is already past. In fact, that's leading optimism in the stock market right now. People believe inflation has peaked, it's going to come off, and consequently the US central bank and the RBA will keep increasing interest rates this year, but then cut them next year thanks to a recession. Are these expectations reasonable? Well, let's look at some charts. In the first chart, you can see here that wholesale inventories are the highest level in 20-something years, so are retail inventories, suggesting companies don't need to buy more stuff. In other words, that should reduce pressure on the supply chain. The supply chain pressure index is coming off, and the supplier deliveries index, as well as the backlog of orders, have fallen considerably, suggesting bottlenecks in the supply chain are definitely easing. If we look at this next chart, you can see prices for random access memory, the Commodity Research Bureau's prices index, and the Baltic Dry Shipping Index have all fallen from recent highs, suggesting supply chain pressures are definitely easing. This is translating into lower expectations for inflation, which is obviously a good thing. And you can see that in the chart on the bottom here. The search term inflation, the trend for that search is declining. Perhaps that means expectations for inflation are declining, and that's a good thing. And of course, that's leading expectations for interest rates to stop rising next year. What you need to also understand is inflation can be broken up in other ways as well. Not only by supply and demand, but also by goods, food and energy, services, and so on. And you can see services form a very large part of the inflation equation. In fact, services make up 73% of core CPI, and services are driven by people, and people are paid wages. And wage inflation is very, very strong right now because there is a huge gap between the number of unemployed and the number of available jobs. In fact, there are roughly 1.7 jobs being advertised for every unemployed person in the United States. Until that gap closes, wage inflation isn't coming down. If wage inflation isn't coming down, then neither is core inflation. That means that the US Federal Reserve might pause on raising interest rates next year, but they might not start cutting interest rates. And that could prove to be a real disappointment for the market. And finally, let's have a look at the charts for earnings expectations in the US market. On this final chart, you can see that for the top 400 stocks, the top 600 stocks, and the S&P 500, the next 12 months earnings per share expectations have all rolled over. If the market is too optimistic about what's going to happen to interest rates next year, and earnings are starting to roll over, then there's a very real risk that this particular rally could peter out. That's all we have time for today. I look forward to talking with you again next week. In the meantime, continue to follow us on Facebook and Twitter.